How do interest rates affect your monthly and mortgage payments? In this video, we're going to discuss interest rates. And why are interest rates so compelling? Why are they so intriguing? Why is that the Fed put so much emphasis on the interest rates? And why do people care about interest rates? Nonetheless, we're only going to talk about housing. And when you go purchase a house, why is the interest rate so important, and how much money you have to pay each month? Before we get into it, hit the like and subscribe button to get more content just like this. So, as we all know, or if you do not know, the higher the interest rate, the more money you have to pay each month. The lower the interest rate, the lower amount of money you have to pay each month. And the same is true with the amount of interest that you have to pay over 30 years. If you're paying a higher interest rate, you're going to pay more money over 30 years. If you pay a lower interest rate, you're going to pay less money over 30 years. So let's begin. We're going to start off with a loan amount of $400,000 and an interest amount of 6%. This loan amount is the amount of money that the bank is going to give you to buy the house. And in exchange for the bank giving you this money, you have to pay the bank back 6% on the $400,000. Now, don't ask me how I got to $400,000. Apparently, $400,000 is the average price of homes being sold in the United States. Last year, they were $350,000, and I believe the year before that, they were at $300,000. So this is why I've chosen to go with $400,000. So let's break down the amortization. So for year one, we're going to take $400,000, we're going to multiply that by 6%. That gives you $24,000. Now, we're going to divide the $24,000 by 12. That gives you $2,000 you will have to pay in interest the first month. Now, as we look at this chart here, our Excel sheet that I created, the first month is going to be $2,000. Now, the mortgage payment is going to be $2,398. Now, I'm not going to explain to you how to create this chart. In another video, I will though. I will break down the amortization for a 30-year mortgage using multiple different interest rates, but not in this video. So, as we see here, the monthly payment you have to pay for a 6% interest rate is $2,398. The total amount of interest is $23,866. The total amount of principal is $4,912. Now, as we switch this to 7%, okay, as we can see, the total amount of payments, the total payment you're going to pay is $2,661 per month. That's not going to change. The interest amount, the total interest amount is going to be $27,871. The total principal amount is going to be $4,063. Now, let's type in 8%. At 8%, the total amount you're going to pay is $2,935. The total amount of interest, $31,879. Total amount of principal is $3,341. Now, as we can see there, the total amount of principal is reduced with a higher interest rate. Meaning that if the interest rate is lower, you're going to pay more towards your principal. Nonetheless, as we look at the amount of monthly payments you have to pay, principal and interest, it tells you that the total amount for an 8% interest is close to $3,000. But an interest rate of 6% is close to $2,000. So every single point when it comes to interest rate will determine how much more you're going to pay per month. Now, as we look at how much interest you're going to pay over 30 years with a 6% interest rate, let's say. So as we see here, the total amount is going to be $463,352. This is the total amount of money you're going to pay. Now, with a 7% interest rate, you're going to pay $558,000 each over 30 years. What this means is that you're going to pay an extra $90,000 from a 6% interest rate to a 7% interest rate. Now, as we go to 8%, the total amount is going to be $656,000. It means that from a 7% interest rate to an 8% interest rate, you're going to pay close to $100,000 more. What does this mean? It means that the higher the interest rate, the more money out of pocket you're going to have to pay